So let's start with sort of a scene setter here, because I believe you last joined Bloomberg Television in November, and you sounded pretty optimistic, I have to say. You said now is not the time to short big tech and that you would much rather be long than short at that moment in time. You fast forward to the end of the first quarter. Are you still feeling that way?
No, but I know I can't stay positive for that long, right? So the war in Iran, I mean, who knows? I think that this is a distraction from the really big story, which is what AI is going to be doing to the job market in the next several years. So to me, AI is going to change everything. So, look, if the war in Iran ends tomorrow and the Strait reopens, markets are going to rip. That dynamic, I don't think there's a way to really trade that, or at least that I know of, to predict that. But what I am concerned about is the long-term health of the U.S. job market and the markets. So that's my focus. That's what I can look at on the long-term horizon.
Well, to follow up on that, I mean, you think about AI concerns. Even before we were talking about what's going on in the Middle East, that was the defining trait of 2026 year to date. You saw the SaaS apocalypse taking down a lot of the big tech names, the sector as a whole. I mean, in your view, it almost sounds like perhaps that was warranted.
Well, that was the wake-up call for me, because until then I hadn't really, I previously messed around with some earlier generations of ChatGPT and Gemini, but when I saw these software companies take a hit, I thought, I don't understand this. I think this would be good for software companies, right? They're going to be more productive, fewer employees. And then I learned, okay, there's concern about their pricing models, but that's what led me to really start digging into this. And, what I think the real issue here is that within a lot of the leading edge companies in technology, their best users of AI have been able to replace 7 of their colleagues. So these teams have gone from 8 people to 1 person with AI. And that's based on the current or even prior generations of AI models. And those AI models are improving exponentially because they are now, this generation has been coded and tested by its predecessor, and it's coding and testing its successor. And so we're no longer on this linear progression path. It's now exponential. So if I look out 3 years, I think, all right, well, if at present point in time, your best AI users have basically replaced 7 of their colleagues, well, I mean, in 3 years' time, with exponential improvement, what about the broader knowledge economy? Do we go from 7 to 6 workers? Is that unreasonable? Especially when we think about certain professions like law. I mean, I'm using Claude now to do legal documents that I used to get billed for. So I think this is going to be just beyond profound.
But I'm just looking at the Mag 7 year to date. Microsoft's the worst performer, down 23%. To your point, Gemini, you would kind of on the surface say they're the only publicly traded company with a real LLM that can be utilized. Why would that not be a place to kind of seek shelter relative to Apple, which is only down 6.5%?
Well, so this is where you get into this whole Mike Green, so Mike Green of Simplify Asset Management, he's been banging the drum for years about how passive has warped the markets. And so when you look at the indices, such as the S&P 500 index, so much of this is driven by passive buying, removing active sellers and squeezing the floats. So over the summer, when I was going back and forth with Mike, he told me that he thought that NVIDIA had a multiple of 100 on it, meaning for every dollar that went into NVIDIA, the aggregate market cap of NVIDIA increased by $100. And so that's great when everything is going well and you have these flows that are positive into SPY and other S&P 500 index funds. But if you have a situation in which there are layoffs and the people who contribute to the 401ks stop contributing to their 401ks and then start redeeming from the 401ks, those flows work in reverse, and those multipliers still exist. So that's when you get the falling knives, and there just aren't enough active managers and investors left, per Mike's theory, which I believe, to catch him. So, and look, to be clear, Mike has not endorsed this AI apocalypse, intersecting with his, market cataclysm due to passive investing. That's where I believe in Mike's view, and I think AI is what causes that cataclysm to occur.
Would you say then that the IGV, that software still has more room to the downside then, broadly speaking, if this is a world that we do continue to see workforces shrink?
Well, so the thing is, almost everything has room to the downside. Yeah. That's the problem. Mm-hmm. Now, do I go and short a bunch of software companies because of that? No, we've set up our portfolio to protect our investors or maybe even capitalize on this AI disruption taking place. I mean, the timing is the part that, do we get the 15% of job losses in 3 years? Mm-hmm. Is it 4 or 5? I'd say 5 years I feel pretty good about that. But I think actually the best way to play that is in credit, in the idea that credit spreads are going to widen. So obviously your Mag 7 companies, if the index crashes because you get outflows, those will do poorly. If you believe in this thesis and you want to protect yourself, should you go and short Mag 7 right now? No, because a lot can happen between now and when this materializes. But I think putting on convex trades, like put spreads, long-dated, out-of-the-money put spreads on ETFs like HYG, LQD, I think that is a better way to play it, and you're capping your downside as well, which, when you're shorting things, risk management is the beginning and the end of everything that you do.
And we were talking about, your view that you think that credit spreads have room to widen here. And interestingly, to me, as an ETF reporter and the anchor of the ETF show, you're expressing that view through ETFs. And I'd love for you to expand on that a little bit. Why use that vehicle to make this trade?
Well, that's part of how we're expressing it. We're also, we manage outside capital, so we have ISDAs, and we're doing some things OTC, but to play the spreads. But so we have put spreads in place on HYG, LQD, and that, if this thesis, when this starts to get priced in, so let me say one thing here, is I think the markets will price this in before the job displacements occur.
Okay.
So, and I do think this will be kind of global financial crisis type fallout in the markets ultimately. And I think it's just on a much faster burning fuse than the GFC was back in 2007, 2008, because information moves much faster. So we've got put spreads on those ETFs, and part of the issue that those ETFs will have is that the underlying can become almost completely illiquid in a real displacement type scenario. Mm-hmm. So you'll have the APs that make the markets for the ETF probably step back. And so people will be redeeming the ETFs, but you can't get liquidity in the underlying. And that's something that's been a risk that's been pointed out for a long time for credit ETFs, especially.
You saw it in COVID, for example.
Yes, and the government had to unfreeze the credit markets there, and it worked. I just think this is going to be a bigger issue. COVID, it was clear. It's like it's a virus. At some point, this passes, but when it's not like jobs that are going away because they've been displaced are going to come back. It's they're gone. So right. I think this will be a good deal more profound. So at least for a moment in time, I think there'll be a real mismatch between the liquidity of the ETFs and the liquidity of the underlying. So if you're short the ETF at that point, you time it right, you can get some extra juice on the downside.
Well, the timing, so much of what we're talking about, the timing is key, as it is with everything. You said that, you think the market disruption will happen before we see that job displacement here, but you have these puts on now. So what sort of timeline do you have in mind when you're thinking about this trade?
Well, the thing that's been, and so volatility has increased recently because of the Iran war, but once we're past that or nobody cares about it anymore, these are equally probable scenarios. Vol will probably die back down. So you can go long puts on these credit ETFs without paying a lot of money, without paying a lot of time value relatively, because vol is so cheap. So that's one reason why I like that better than say, doing put spreads on the S&P 500. I mean, we have some of those as well, and we have some other equity trades. But, in terms of timing, it's hard to say. I felt like things were moving just from conversations I started having with investors whom I consider to be smart money, like about beginning of February, just started having conversations, and everybody I talked to saying, yeah, my partners and I are talking about this right now, just had a call about this, and what's this going to do? And I think this was really moving quickly, but the Iran war has distracted a lot of people from thinking about this. But like I said, we either get bored of the Iran war or it ends somehow, and attention will refocus on this at some point. And as it percolates through the markets, then I think you will start seeing spreads widen. I mean, spreads have already widened a little bit since we put the trades on, even before the Iran war. So felt like maybe it was percolating a little bit. But vol is just, especially in credit markets, just been too cheap. So, yeah, I think that's the opportunity.
I want to pivot a little bit to coming back to kind of the notion of what AI is going to do and thinking about the names that could go public. OpenAI, Anthropic, SpaceX, three massive companies. What would you make of, or what do you make of some of the numbers being floated around? We've reported SpaceX wants to go public at $1.75 trillion. We can only see what OpenAI wants to go at. How would you handicap that, and what would you benchmark that to?
I mean, like, I'd be curious as to how big the floats will be,
Yeah.
because I can't imagine that, 1.75 trillion IPO, you're going to have a huge float. But yeah, I mean, the numbers today are so big after years of emergency monetary policy following the GFC that I don't know. I mean, I'm almost numb to the numbers. But like I said, as the scenario plays out, everything does poorly for a while. In the aftermath, there are definitely companies you'd want to own. Like, you'd want to buy them in the fallout of massive correction. And some of these are probably among the names you'd want to buy.
But how would you position around to the short or long side any of these three companies, given how markets have evolved since COVID, where retail is such a big proportion of the market? I can only imagine what the chatter on a Reddit or some of these trading boards would be around the event of an IPO. And even to your point, if we only are seeing 4 or 5% of the shares floated.
Yeah, I wouldn't be long or short.
Yeah.
I'll put it that way. I mean, we have a strategy that we developed where we're long. Every month we rebalance. We're long 20 S&P 500 constituents. We're measuring momentum, and so if they make it into the index and they score on our momentum strategy, then we'll be long it. Like, for a while, starting in 24. We were long Palantir for a number of months. It was our number one holding, and it did very well. So through that filter, if it scores, we're agnostic. Like, we'll buy it even if there's, even if we just can't justify the valuation.